mentioned the increase in diligence and the sort of increased operational scrutiny. Having David as a buy-side representative and Mike and Jaeson sort of the other side of the fence, and Mark as a traveling partner. David, what are the things that you're thinking of doing or you're doing from an operational perspective to distinguish yourself? Obviously, investors will have new levels of diligence on funds, and Jaeson, Michael, what are you guys looking for that is different, or how do you define operational quality?
Yeah, let me just say that in the last 6 months, I would say the increase in diligence that most of the consultants and or diligencers of asset allocators has picked up. The pace has picked up significantly, and they're interested in coming in and not meeting with the chief investment officer or research analysts on our investment process, but they want to meet our general counsel, they want to meet our compliance officer, they want to meet our chief financial officer, our IT director, and they want to really look into the infrastructure of the organization. So that's clearly not an insignificant issue that you mentioned. But on the point of these other issues, Third Avenue being a long-only biased organization, which the bulk of our assets are actually in Investment Company Act vehicles, we have always been a registered firm, had great transparency, had outside. The Investment Company Act is a complicated statute, but it's also a very protective statute, and it actually works in the sense that it's provided all of these issues that unregistered funds in domiciles outside the United States did not provide in terms of liquidity, transparency, fee disclosures, embedded securities in portfolios. All of these issues could be very clearly analyzed in a quite short period of time. So with the exception of the fact that I've seen the pickup on the other side of the diligence, we've always been able to offer those who have evaluated us great transparency about what we do and what's in our portfolio.
I think I said most of the key things, but maybe just to elaborate very quickly on the funding and counterparty issue. I'm sure everyone in this room knows generally what I mean by that, but obviously when you go through a period with major counterparties struggling mightily or declaring bankruptcy, you should stand to question how did the firms manage that? First of all, how aggressive were they in moving their counterparty risk around? Secondly, how good were their agreements in place ahead of time in terms of how stable was their funding if they have leverage, and what kind of terms do they have in terms of financing, changes in financing, locates, how much transparency do they give these firms, and if there any is there clarity around the fact that the information can't be used against them? I think some of these are very straightforward questions, and maybe you've already thought about them, but I don't think it's been institutionalized well enough to the point that you really look at how stable is the funding for a leveraged institution.
Thank you. Michael?
That's a great point. So, I think we look for all the above. What Jaeson pointed out here is absolutely true. If you start, investigating these hedge funds, you would be surprised at the amount of misstatements, out-and-out lies sometimes, and I think you probably find that in every walk of life. A lot of this industry, started it's guys that spun out of larger firms, and it's very, very hard for them. Maybe they have the investment expertise, but if you look at the growth in this industry, it's very, very hard to expect that all these guys have, recreated that infrastructure and that operational expertise. I don't think there's enough talent out there, and often the firms that it came from didn't even have a good culture there. So, we try to do it all ourselves. We've hired an independent third party to really, help us do this better, do extreme due diligence in that area. And the one thing we learned from last year, pricing really can be squirrely, in these level 2 and 3 assets. So how do they price it? And be very, very careful on that.
Thank you.
I would again focus. Has anyone ever here done internal auditing? I know it sounds like a funny question. One guy. So we'll have lunch together later. and talk about this. When you do internal auditing, and I did that for about 3 years with a firm called Squibb here in New York, where I was all over the world, looking at operations, you don't care what the end number is. What you're looking for is the NAV factory and how the NAV is calculated. And you'd be surprised at how detailed that is. I think that we're now coming into having that internal audit function, if you will, just in its substance, kind of carry over into the operational due diligence side. From our side, we started in '07. We have our chief compliance officer for the firm that also runs a group, a small team of people that actually go out on site and do the operational due diligence on a separate track. But we still have, if any of you have filled out what we call our 3D review, we have 2 levels, and the second level is one that goes into questions about operations, strategy, and so on. And those are fairly, I think comprehensive is the word I would use to describe what we're trying to understand, so that when we're on board, we can, we don't want to take, we just don't want to have somebody looking at strategy and somebody looking at operations. We want to have the strategy team, if you will, looking at everything, and then have somebody backstopping us on the operations, because I don't think you can do a good enough job understanding what a manager does if you don't look at the back office as part of your due diligence, and it has to be almost the same people.
Thank you. Let's come back to the 3 keywords that are coming up a lot: liquidity, transparency, and fees. So a lot of discussion, a lot of scrutiny on these topics. Could you comment on specific changes that you foresee on any or all of these 3 areas? We'll start with David again.
Yeah, first, if you don't mind, I don't know if everybody saw the FT wrote an article, I think it was a day or 2 ago, about how 80% of the hedge funds lie in diligence processes. And I'm just curious if you guys at some point, to your point about, but maybe comment on that a little bit, because I'm curious about whether the FT was sort of blowing that out of proportion. If they say they manage 15 billion, they manage 14.9 billion. Is that what fell into that? But clearly, again, on an open-end fund like we manage, transparency, fee disclosure, all those issues are pretty clear. Liquidity, we don't borrow money to invest, so not using leverage has helped us weather through the last 12 months fairly well. But I do think that fee compression is definitely coming to bear down on us, and will continue to increase. In our marketplace where we compete, we're hearing stories of so-called active managers reducing fee proposals down to something like 25 basis points for long-only accounts, which is just, to us, insanity, but you'll ultimately get what you pay for. And so there's definitely a trend coming in terms of people trying to recapture their business that they lost, because we are an AUM business, and folks at firms are under pressure to figure out a way to grow AUM, and if they have to chase it by reducing fees, I think that's going to be probably a symptom of what, or a result of what happened last year. I mean, that's one comment I've seen from my side.
So on a systematic basis, you see sort of fee compression becoming the norm over time?
I see it being a factor. I think it'll be interesting to see whether folks who are making asset allocation decisions, sacrificing their decision making for a fee chaser, and you've heard about or read about some of the let's just call them more sophisticated decision makers gravitating toward indexes. And if they can get an index in the form of an active management for a fee that's like an index fee, maybe they'll start selecting those folks to manage money for them. But it's sort of an interesting trend. It scares me a little bit, but until the market fully recovers for some period of time, when people start going to chase the hot dot again, that's probably what we're going to see for a little while.
Thanks. Mark?
One of the most pronounced characteristics of our industry is noise. Returns have noise in them. There's not a lot of information in short-term returns, and I think everyone knows that, but they don't always act that way. In my opinion, over the next period of time, so decade or however you want to define it, I think we'll see more bifurcation in performance into systemic or systematic type factors and pure skill, pure alpha.